Hi folks, welcome to a quick run through of the All-Star numbers. I'm going to start with the income statement for the first year, and I'm going to follow the order of the income statement going back to the data to find the information. So first up, we were told that sales was 4 million. We were also told that it's all on credit. That suggests that we are going to have some debtors in the balance sheet. 80% of the sales was paid across to the suppliers, hence that's cost of sales, and the remaining 20% is the gross profit. We were given the general and admin expense. We were given the selling costs. They gave us a percentage of sales, and we were told that the depreciation for the fleet of vehicles was 225,000. So you had to just plug those in. If you add those together, you get the 610,000 in expenses on top. 800,000 minus 610 gets us to 190. They said to us there's no debt in the first year, so therefore there is no interest expense to deduct. We are left with 190,000. Of the 190,000, 35% is paid in taxes. That leaves us with 123,500, and of that 20% is paid to the shareholders in a dividend, and that leaves us with 98,800 Rand. This money needs to flow into the balance sheet. It is money that belongs to the shareholder. So the logical place is to go from completing the income statement, let's go onto the balance sheet. And I'm going to start with the retained earnings here. This number is 621,800. And this is taking the 98,800 from last year and adding it to the retained earnings that they gave us in the story, which I think, if I go from memory, is 523,000. 200,000 shares were issued to the two shareholders at 1 Rand a share. It's important to note that the authorized shares do not represent money until they are sold to a shareholder for which the company receives money. So only issued 200,000. Add the shares plus the retained earnings to get the total equity. Add the total equity to the total debt. In this case, long-term debt was 0. So hence our total capital is 821,800. At this point, you can take this number 821,800 and you can come down here and you can plug it in to the net asset number. Because these are the opposite sides of the balance sheet, they must equal each other. The fixed assets, 450,000. They said that was the net book value. That information was given to us. They gave us the stock number. The debtors, we had to calculate that. The way I calculated it, if I show you some workings over here, I've got a simple timeline here from January to December. In January my sales are 0, but by the time December comes along, there's the 4 million in sales. And they said everything we sold in the last 44 days, this last almost month and a half of the year, has not been received. I want to find out what is 44 days worth of sales. 4 million divided by 365 gets you a sales per day times 44 tells you how much was sold in the last 44 days, and hence how much your customers owe you. This makes a huge assumption. It assumes that we sell the same per day, hence our sales line here on our triangle is exactly straight. It doesn't take into account any seasonality, but it's good enough for this exercise and to get our mind around the debtor days function. So there we have the debtors. We were told that the creditors was 232,800 and that there is no bank overdraft. So if you add these two together, you've got the current liabilities. We don't know the cash, and therefore we don't know the current assets. We do know the net assets. We don't know the net current assets. This number here is CA minus CL. Our challenge here is to solve for cash. Let's go back to my workings. To do that, I use this formula. Net assets equals fixed assets plus current assets minus current liabilities. I plug in the information that I have for each of the components in here. The one missing piece is C. and I'm solving for C. I'm solving for the missing variable, and there's the answer, 43,408, and that completes the first year's balance sheet. Moving on to the income statement for the second year. Here it's important to recognize that you have 2 revenue streams and 2 cost of sales and 2 GPs, and you need to combine this detail. So back to the workings. Sales in agency business has declined to 3 million. 80% of that is paid to the supplier, 20% is retained as a margin. In the manufacturing business, 5,000 mattresses are being sold at 600 Rand a mattress, and therefore we have to buy those 5,000 mattresses at a price of 380 Rand. That provides us with a margin, and add these 2 components together, you end up here with the 6 million less 4.3 million gives us the 1.7 million, and that data you'll see I've used here in the income statement. We were then told the general and admin, we were told that the selling costs have reduced as a percentage of sales, and we had to calculate the depreciation. It's important to recognize now that in calculating the depreciation you have 2 assets. Let's go to the workings here. We have a fleet of vehicles which started the year at 450 and is depreciated by 225. It gives us a value at the end of the year of 225. We've got a manufacturing plant of 1.2 million, which is depreciated over 4 years. That's the contract duration. That provides us with 300,000 per year in depreciation, and therefore the value at the end of the year is 900,000 Rand. Add the 2 vehicles depreciations together. Sorry, let me correct that. Add the 2 assets depreciations together, one asset being a fleet of vehicles, the other being the manufacturing plant, and hence you have the total depreciation for the year. Add the value of the 2 assets to get the total value, the net book value, in the balance sheet. That's the 1,125,000. Right, back to the income statement. So now we know where the depreciation came from. Add your expenses, deduct them from your gross profit, it gets you 875,000. Less the interest expense gets you profit after tax. Less the tax, 35% of the profit after tax, gets you to the earnings after tax. Less the dividend. Remember, they changed the policy. 20% was increased to 40%. Subtract the dividend and you are left with the retained earnings, the number that you take to the balance sheet. Let's do that. If we head over to the balance sheet, we want to add this number to the existing retained earnings, which is the 621,800, to get the new retained earnings. Now, there is often a lot of confusion around these ordinary shares, because we see that a deal is being done between Ashok and Pravin, where one is buying shares from the other at a share price of 4 Rand. The question you have to ask yourself is, in this transaction, so if this is All Star and here are the shareholders, this transaction is being done between the shareholders. Does any of the money go into All Star or come out of All Star? And the answer to that question is no. This is a third-party transaction that does not include the business. And the fact that the share price has gone up doesn't mean any more money arrives in All Star. So therefore we cannot change the share capital of All Star. And the change in share price does not constitute a change in the share capital of the business or the receipt of any money for the business. So back to the balance sheet. Hence my ordinary shares remain the same. Add these 2 together to get the total equity. Equity plus debt gets you to total capital. Take this number, plug it in down the bottom. Your balance sheet must balance. There's the value of the assets that we calculated just now. We were given the stock. We were given the debtors. You were given the cash. You just had to put them in the right place. Add them up to the total of the current assets. Some of those in there. We were given the creditors. They told us that this number is the same as last year. Therefore, the only missing number to get our balance sheet to balance is to calculate the overdraft. And in my workings over here, I did this overdraft calculation, and you'll recognize that same formula that I used for the cash calculation in the previous year. The only difference between these two is last year we were looking for C. This time we're looking for overdraft, which is part of the current liabilities. So remember, in this calculation, remember your brackets, because that minus outside the bracket can be a little bit tricky. You must multiply that minus through the bracket. Some good old algebra there. And then solve for overdraft in order to calculate the number that balances your balance sheet. Bit of housekeeping. The net current assets is CA minus CL. You don't need this number to balance the balance sheet. It's just extra information. In fact, this number is what I've referred to as the working capital. I hope that was helpful. See you in the next one.